Welcome to our deep dive on why investing surplus cash in a taxable brokerage account often beats letting money sit idle while you wait for tax-advantaged allowances to reset. We will explore inflation's impact, time in the market, tax allowances, and a practical step-by-step plan. Let's get started, and then we'll set the stage with a quick agenda. Here's our roadmap. First, the core idea. Next, we compare inflation versus inaction. Then we visualize the decision with a flowchart, compare idle cash with taxable investing, and emphasize the time-in-market advantage. We will examine timelines, look at an illustrative tax allowances snapshot, and finish with a practical action plan and smart tax tactics. We will also reinforce learning with quizzes. With that, let's briefly cover an important disclaimer. Before we proceed, note that this content is educational and not personal financial advice. Tax policy and allowances change, and they differ across countries and even within regions. Any figures shown are illustrative and may not reflect current rules. Your circumstances are unique, so consider consulting a qualified professional before making decisions. Now, with that context established, let's capture the core idea in plain terms. Here's the core idea. Maximize your contributions to tax-advantaged accounts first. Then, instead of letting extra cash sit idle for months or years while you wait for allowances to reset, deploy the surplus into a standard taxable brokerage account right away. Inflation steadily erodes purchasing power, and compounding rewards time in the market. In short, do not let tax optimization paralysis cause investment inaction. With that foundation, let's quantify how inflation punishes idle cash. Inflation silently reduces the purchasing power of uninvested cash. While nominal balances may look stable, real value falls over time. Waiting multiple years just to avoid a potential tax bill later may cost more than the eventual tax. Compounding requires time to grow. Delays reduce the compounding runway and lead to smaller long-term outcomes. To make this concrete, let's visualize the decision process with a simple flowchart. This flowchart begins by asking whether you have maximized tax-advantaged accounts. If not, contribute there first and recheck. Once maxed, it asks whether you still have surplus cash beyond allowances. If not, maintain your emergency fund and keep contributing as normal. If you do have surpluses, ensure your emergency fund is adequately funded. If it isn't, top it up and reassess. If it is, invest the surplus in a taxable brokerage account, select a diversified low-cost portfolio, automate contributions, and rebalance periodically. Next, let's compare idle cash against taxable investing side by side. On the left, idle cash loses purchasing power to inflation, earns little, and compounds opportunity cost. The perceived safety is often illusory when adjusted for inflation. On the right, taxable investing participates in market growth, uses time to compound, and can leverage annual tax-free allowances. Additionally, investors can manage gains and losses to optimize tax outcomes. Building on that, let's reinforce why time in the market is so critical. Empirical evidence shows that time in the market generally beats attempts to time the market. Missing just a handful of the market's best days can materially reduce long-term returns. Delaying an entry, even by a year or two, can lead to substantially smaller portfolios in the distant future. Therefore, consistency and automation often outperform attempts at perfection. To translate this into a timeline, let's compare waiting versus investing over a short horizon. This timeline contrasts two paths. Path A holds cash for 36 months, while inflation reduces real purchasing power each quarter. The nominal balance may appear stable, but real value declines. Path B invests immediately in a diversified, low-cost portfolio. Although the invested path experiences volatility, compounding begins right away, and the expected trajectory is higher over time. This reinforces that starting sooner generally improves the probability of better outcomes. Now, to ground our discussion, here is an illustrative snapshot of common allowances. Remember to verify current figures for your jurisdiction. This table provides an illustrative snapshot of common UK-related allowances. ISA annual allowance, capital gains tax annual exemption, dividend allowance, and the personal savings allowance, which varies by income band. These numbers change over time and may not be current. Viewers must check the latest official guidance. Importantly, many investors can realize some growth or income before incurring tax, which further argues against leaving surplus cash idle. With that in mind, Let's turn this into a simple action plan. Follow these steps. First, maximize tax-advantaged accounts. Second, ensure your emergency fund is adequately sized. Third, invest surpluses immediately in a diversified, low-cost taxable portfolio. Fourth, automate contributions and periodic rebalancing. Fifth, manage realized gains and losses prudently to use annual exemptions. Finally, review annually and adapt to any new tax rules. Before we move on, let's test your understanding with a quick quiz. Quiz time. Which factor most commonly makes waiting in cash a losing strategy compared to investing surplus in a taxable account? Option A. Future tax rates might fall. Option B. Inflation erodes purchasing power while compounding is delayed. Option C. Cash always outperforms stocks long term. Option D. You can time the exact market bottom. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is inflation erodes purchasing power while compounding is delayed. Inflation diminishes the real value of idle cash, and postponing investment sacrifices compounding time. These effects often outweigh the potential benefit of lower future taxes. Now, let's briefly highlight how to sequence contributions to maximize efficiency. The recommended sequence is to channel as much as permitted into tax-advantaged accounts first, and then immediately deploy any overflow into a general taxable account. Over time, use annual exemptions and allowances to manage realized gains efficiently. Next, let's detail a few practical tactics for improving after-tax outcomes. Consider these tactics. Use your annual capital gains tax exemption deliberately to realize gains while minimizing tax. Where permitted, use mechanisms such as APALA, BED, and ISA to transition holdings into tax shelters when allowances reset. Harvest losses, within rules, to offset gains. Prefer diversified, low-turnover funds to reduce frequent taxable events. Finally, be mindful of dividend distributions and the placement of higher-yield assets to visualize what drags returns. Let's look at a pie chart of typical frictions. This pie chart breaks down common drags on investor returns: inflation, fees, taxes, cash drag, and behavior gaps. Inflation often represents a significant portion of the drag, especially when cash balances are elevated. Fees can be managed by choosing low-cost funds. Taxes can be reduced by using allowances and efficient asset placement. Cash drag results from holding excess idle cash. Behavior gaps represent performance lost due to suboptimal timing or reactions. Now, to cement the concept with a quick calculation, let's move into a markdown mini-lesson. To approximate real return, take nominal return R and inflation id, and use the formula. Real is approximately equal to 1 plus R divided by 1 plus I minus 1. For example, with a nominal return of 6% and inflation at 4%, real return is roughly 1.92%. The key takeaway is that delaying investment shortens the period over which any positive real return can compound. Let's reinforce this with one more quick quiz. Here's another question. After maximizing tax-advantaged accounts and funding your emergency reserve, what should you do with surplus cash? Option A. Hold it in cash until next year's allowance resets. Option B. Dollar cost average into a diversified taxable portfolio immediately. Option C. Speculate on short-term market moves. Option D. Wait for interest rates to peak before investing. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is to dollar cost average into a diversified taxable portfolio immediately. Automation helps maintain discipline and ensures your money participates in market growth as soon as possible. With that confirmed, let's capture the main takeaways. These are the key takeaways. Inflation diminishes idle cash, so time in the market is crucial. Maximize tax-advantaged accounts first, and then invest surplus in taxable accounts. Use annual allowances to manage gains, automate and diversify, and review your plan each year. Finally, do not let fear of taxes drive you into inaction. Let's wrap up with a concise summary. In summary, waiting for perfect tax conditions can cost more than paying some tax later. Start compounding now because inflation does not wait. Leverage annual allowances to optimize over time rather than postponing. automate and diversify to support durable results. As a final note, I'll sign off with a thank you and a friendly request. Thank you for watching. If you found this useful, please like the video, share it with someone who might benefit, and subscribe for more. I would love to hear your strategy against inflation and how you approach investing surplus cash, so please share your thoughts in the comments. See you in the next one.